Imagine following Warren Buffett's S&P 500 advice for decades, only to watch your retirement savings evaporate in a sudden market downturn. While Buffett preaches long-term investing, he doesn't tell you how many times your will to keep investing will be tested when the stock crashes. What if the safe bet is actually a gamble you can't afford to lose? Warren Buffett often suggests that most people invest in the S&P 500 index. Why? Because it's a simple and relatively safe way to invest in the stock market. The S&P 500 represents 500 of the largest American companies, providing broad exposure to the U.S. economy. This diversification helps to reduce risk compared to investing in individual stocks. One of the biggest benefits of investing in the S&P 500 is its potential for long-term growth. Historically, the S&P 500 has provided good returns, and with the power of compounding, your investment can grow significantly over time. Plus, S&P 500 index funds are generally low cost, meaning you keep more of your investment returns, rather than paying high fees to fund managers. But it's important to know that even Warren Buffett's recommended investment strategy has risks. The stock market can be volatile, and the S&P 500 can experience downturns during economic recessions or market corrections. While the S&P 500 offers diversification, it doesn't eliminate risk entirely. It's possible to lose money, especially in the short term. Sometimes, actively managed funds might outperform the S&P 500, but this is not always consistent. This strategy is often suited for young professionals looking to start investing for the long term, late bloomers aiming to catch up on retirement savings, DIY investors who want a solid foundation for their portfolio, soon-to-be retirees seeking stable investments, and even international investors looking for exposure to the U.S. market. However, your own situation is always unique. Before making any decisions, you should consider your risk tolerance, how long you plan to invest, and your overall financial goals. Don't put all your eggs in one basket. Ensure your portfolio is diversified across different asset classes. Despite the attractiveness of passive investing in the S&P 500, there are still open questions about the impact of extremely prolonged bear markets on investor psychology. How does consistently applying dollar-cost averaging strategies play out when returns are negative or minimal for a decade or more? The long-term historical returns look great, but the emotional aspect of staying the course during prolonged downturns deserves more attention. Also, there's the question of tax efficiency, such as how frequently are the index funds rebalanced and what are the tax implications. These are important for investors to be aware of, but these topics are often left untouched. If you found this video helpful, please like, share, and subscribe to our channel for more insightful content on investing and personal finance.